Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
This is ETF Market Insights. I'm your host, Danielle Nezel with BMO ETFs. It's great to be back on the channel. I had to step away for about a year and a half. So much in the market has changed, and I'm so excited to be back talking about ETFs and investing with all our audience and all the Canadian investors that are watching today. Before we get started, a reminder. We're not providing you investment advice. We're not providing you any investment recommendations. Today's show and all our shows are about educating Canadian DIY investors. Joining me today is Bipan Rai. Bipan, it's so great to sit down with you. I've been following you while I've been off, and I'm so excited to have you on the channel today.
It's good to be here, and welcome back, Danielle.
Thanks. So Bipan, you sent out a report this week, came across my desk, and it really caught my eye. And it was all about stagflation. Now, I've been investing since about the early 2000s, and I don't think I've ever really encountered stagflation as an investor, and I think a lot of our audience today can probably feels the same. So I thought this was a really good time to talk about this environment and how it's going to affect our portfolios. So let's just break it down right at the beginning. Economics 101. What is stagflation, and why do central bankers have such a tough time with this kind of environment?
So, like with most economic concepts, stagflation is completely subjective, or there's an air of subjectivity about it. Now, you mentioned earlier that you can't quite recall an environment where we had to deal with stagflation, but again, that depends on how we define it. Certainly there have been periods of extreme stagflation, which of course correspond to the 1970s, but we have had mild cases since then. So, to answer your question, Danielle, I mean, stagflation is really just an economic condition that is, again, particularly challenging for policymakers. And the easiest way to define it for the broad audience is that it corresponds to a backdrop where we have slowing growth and a rising unemployment rate, but counterintuitively, that also corresponds to an environment with rising prices. Now, central bankers, their tools are rather blunt instruments. In situations where growth is low and the unemployment rate is rising, I mean, the remedy there is, really easing rates, because we're dealing with a situation where the economy is operating with a degree of slack. If the central bank does cut rates in that environment or expand its balance sheets, hopefully that does induce additional spending at the business level or even promote household consumption. Now, in situations where inflation is high, growth is usually close to potential in the economy or even exceeding it. The economy, said differently, is operating in an environment of excess demand. And so what the central bank will usually do in that environment is raise interest rates to curb demand at the margin and to bring inflation lower. But, central bank tools are rather ineffective when we're dealing with, stagflationary backdrop. I mean, what do you do if growth is slowing and the unemployment rate is rising at the same time that inflation is? I mean, clearly then you have to prioritize one of those objectives, either slower growth in addressing that or addressing the rise in prices. And oftentimes what we've noticed over the past several decades is that a lot more central banks, when faced with that trade-off, will tend to focus a little bit more on curbing price pressures.
So to be clear, your report actually talks about stagflation fears or bubbling of stagflation potentially in the U.S. economy. Now, the Canadian economy seems to not be going through the same things as the U.S. economy, but we're still watching the U.S. economy. So I want to know first, what's going on in the U.S. that's kind of taking us down this road? And why should Canadian investors care about what's going on in the U.S.? If we're okay up here, why does it matter what's going on down there?
I mean, certainly, you could sort of look at the two economic backdrops and see a noticeable difference. I mean, in the United States, clearly the equilibrium level of growth is higher. But what we've also seen is a meaningful shift in trade policy that has raised trade barriers. And at the margin, you could expect that the increase in tariffs and the average effective tariff rate, really from, say, 2 to 3% heading into this year to now probably closer to 15 to 16%, that is going to lead to higher prices over the long term when it comes to imported goods. Not just at the household level, but also for businesses as well. And, you could say at the margin that the tariff rate to the average effective tariff rate in Canada has also gone higher, but certainly not to the same degree that it has in the United States. So you could sort of look at the two different trade backdrops and say that, the trade-induced price shock is a little bit higher in the United States relative to, say, Canada. But, nonetheless, I mean, what we have seen in Canada is a more forceful easing cycle started by the Bank of Canada last June, whereas, the Federal Reserve did cut rates a few times late last year, but then, went on a long or extended period of pause. And, there is a good chance that the Fed could elect to cut rates later this year. So, we are seeing a divergent path between the two central banks, which really speaks to the fact that the two economies are now operating at different speeds, not just in terms of real activity, but also in terms of price pressures as well. Now, why should Canadians care? Well, again, remember that for a lot of Canadian investors, the largest exposure outside of the country is to the United States, right? So again, the clearest impact on Canadian investors will be, to the degree that they hold U.S. assets. And, in the past, what we have noticed is that a stagflationary backdrop in the United States does have a meaningful impact on Canadian investors insofar as they hold U.S. equities and also insofar as they hold other real assets that may be denominated in U.S. dollars globally, including gold.
Okay, so I am a long-term investor. I like to call myself a buy and hold investor. A lot of people watching today are in that camp. I don't look at my portfolio every day, but if I do peek at my portfolio and, we are in an environment of stagflation, what can I expect to see?
So one of the things I think is important to flag, Danielle, is that, whenever we look at, a period of stagflation, let's say, it lasts 6 to 8 months. I mean, the one thing I don't want to be, the one thing I don't want to say is that we're going to see the same degree of price behavior for across all assets during that entire block of time. We don't think that's the case. What we do notice is that oftentimes price behavior does tend to rhyme from cycle to cycle, especially in the early phases. Now, if we define stagflation as, those months where we typically see the unemployment rate rise above 50 basis points from the 12-month low, and also, the same months where core inflation is tracking north of 2.5%, then typically what we tend to see is an equity drawdown in the initial phase that could range anywhere between 5 to 20%. And again, that drawdown period tends to be close to 4 to 5 months. So we tend to see the equity market bottom 4 to 5 months after the initial stagflation period has started. And then after that, it does make sense for long-term investors to look for value in the equity market insofar as the sell-off is concerned. And as the stagflation backdrop continues to proceed, generally we do tend to see a bottom close to the earlier phase of that backdrop. And then also in the initial early phase of that backdrop, we tend to see gold outperform or preserve its real value a lot better than equities do. Certainly there will be periods where gold will underperform, but more often than not, we tend to see gold hold its value relatively well.
Really interesting. So looking at about a quarter to 2 quarters of a decline, and then hopefully kind of equity markets climbing out of that after that dip. So for long-term investors, that's kind of what they can expect from a stagflation period. Okay, so let's now turn to tactical investors. So these are investors out there who try to be nimble and want to take advantage of a market opportunity, or maybe just position themselves a little more defensively. So Bipan, I thought we could play a little game called Bullish or Bearish with Bipan, and we could go through a few asset classes and you can tell me how you feel about those asset classes in stagflation. Okay, so we're going to start with equities.
So I'd say neutral to slightly outperform. And I know we've been talking about stagflation, and I just want to hammer home the point right now that stagflation is a risk to monitor. Insofar as the actual view is from here, I mean, yes, sure, stagflation is the risk, and valuation does look a little bit iffy, but earnings are still strong. And, I want to be long large caps, particularly when we're getting closer and closer to Fed rate cuts, I should say. We still feel that despite the lofty valuation and also the fact that stagflation looms large as a risk, that the fundamentals are still quite constructive when one looks at equities.
Okay, what about fixed income?
So right now we're bearish, Danielle. Most central banks are by and large done with their easing cycles, and it's not clear to us that the Federal Reserve will ease by as much as the markets are currently pricing in. Trump risks, insofar as interference with the Federal Reserve notwithstanding, we do think that a constructive argument for fixed income would have been that central banks are embarking on additional level of easing, but we don't think that's the case right now. Additionally, we are worried about the role that fiscal dominance will play when it comes to central bank policy on a go-forward basis. And that could have meaningful implications towards the back or the long end of the curve with respect to supply. So right now, when it comes to fixed income, we adhere to a bearish view.
What about gold? This was a highlighted asset class in the report you just wrote.
Right. So we're still constructive. And yes, we are aware of the fact that gold has rallied quite substantially over the past 12 to 24 months. But we also think that speaks to the fact that the regime is shifting. If we're looking at the White House and President Trump's repeated attacks on important market institutions, namely the Bureau of Labor Statistics and the Federal Reserve, and the reconfiguration of global trade, both of those imply that we're probably past peak valuation insofar as the U.S. dollar is concerned.
U.S. equities?
So if we look at the U.S. economy, we're neutral, but on the U.S. market, including equities, we're constructive. And the reason for that is, if we look at capital expenditures related to artificial intelligence, that is something that is benefiting both the U.S. markets, including equities, and also the U.S. economy. We think that it's probably going to be around for quite some time.
And Canadian equities.
So I'm going to do the same thing. I'm going to split between the outlook for the economy and also for the equity markets as well. So the answer is neutral for both of them. At this point, we look at the Canadian equity market. We do like industrials as a sector on its own, but we are, sort of coloring that with a cautious sort of outlook, given the fact that, again, really we're entering into uncharted territory insofar as trade is concerned, and what that means for real activity in the Canadian economy going forward. And then, of course, what the pass-through effect could be for some sectors.
I have one more question for you. We are ETF Market Insights. So I want to know, Bipan, you could pick one ETF heading into environment with stagflation risks. What would that ETF be and why?
Certainly. So the one that I feel is a compelling play is the ZWGD. That is the BMO Covered Call Spread Gold Bullion ETF. Now, the neat thing about this particular brand of ETF is that it does tend to track the price of gold, but you also get the benefit of earning an attractive yield as well. And again, this is a product that should do well, or at least is for those investors that are a little bit worried about extant levels of valuation for gold. And are looking for a yield kicker to help alleviate some of the let's call it some of the reluctance when it comes to just funds that track gold on its own. So again, we think the ZWGD is really well placed within a portfolio to do well, especially during times like these when you can make a reasonably sound case that valuation is a little bit stretched.
And if we do enter a stagflation period, you did mention in that report that gold, the drawdown of gold historically hasn't been as severe as the drawdown of equities. So that's a really great ETF to consider. Bipan, thanks for taking the time and all your insights around the economy and the markets.
My pleasure, Danielle. Thank you.
And that's it for us today on ETF Market Insights. We hope to see you again next Friday. Take care.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.